Well, let's get a move on then and bring on board Rajat Rajgarhia of Motilal Oswal Financial Services, who joins in to talk a little bit more about the budget as well as the market reaction. And I think, Rajat, this time around, the fact that it wasn't a populist budget or a disrupted event and had, fewer surprises and more continuity, is that what the markets wanted?
Well, I think if you just track the way the budgets have been presented over the last few years, while typically we do build up a lot of excitement, prior to the budget, it is kind of becoming a more intent document where the government specifies their priorities and a lot more about the number crunching around the fiscal deficit. Specific taxation related, I think there are so many things which happen throughout the year. And now, a lot of the excise gets covered into GST, direct taxes. We are into a more stable regime, right? I think not having anything really negative on the taxation is something which I think has been a big takeaway for investors from this budget.
I wanted to also get in a sense, Rajat, as to how then you are playing some of the cyclical names given the kind of announcements that have been announced in the budget. Do you believe that they're good to go for a long-term play?
Well, I must share that there is really not any change in the preferences or the topics that we are making just on the budget itself, right? In fact, if you ask me, our view on the markets, our view on the stocks that we continue to like, a day before the budget and the day after the budget is almost the same. Virtually, there is very little change because I think there are the factors which are going to influence the markets and the stocks are going to be a lot more outside the budget than just that one day event. And since you mentioned about cyclicals, etc., I think each one of them have to be looked purely on count of two things. Are we getting more positive on their earnings from here? And secondly, are we able to buy them still at reasonable? I think the answer in both the cases is yes for a lot of the stocks. So we used to like them last week also, and we used to like them today also.
Right. Rajat, just understanding going forward as to what the market texture is going to be. While, of course, the budget has come and gone, but, traditionally we've been chatting with our experts as to how the significance of budget on markets has been weaning off. Do you think from today itself, it's back to really tracking global cues, what the Fed is going to do, and more importantly then, what the RBI action is going to be? Whether RBI is going to continue to remain hawkish, or are they going to change their tonality and align themselves with the government as they have so far, and not be in a hurry perhaps to raise rates, even though that the Fed may?
Absolutely. I think the discussion is no more whether RBI will be hawkish or dovish. I think the discussion is that at what point of time we see the RBI also looking to raise rates, because this year, I think the Fed has been on a very different tangent, increasing their rate bets from 2, 3. Now people are talking about 4, 5. And given the inflationary pressures that you are seeing, not just globally, but in India, right? And some part of that is good also because that comes along with the growth. I think more importantly is at what point of time we see RBI raising the rates, whether it is in the next policy after next, right? I think question is more of timing. Question is not whether this year we will see the rate hike or not.
So in that line, Rajat, I mean, does one really need to worry about, a reaction from the markets? Because markets typically don't like change and they don't like money getting expensive. I mean, having said that, historically, one has seen a raging bull market even in high interest rate regimes. But when it were to be, spelled so by the RBI, we're definitely going to see a knee jerk from the markets.
Well, I can tell you that the fear of the events typically have a more bigger impact than the event itself. And the last 1.5 months, the US Fed has casted enough fear in the global markets about how they are going to behave this year, right? And India is going to react a lot more to how the global rates do. because we know that with some timing difference, we will see the impact of that coming in our market. So markets typically tend to discount some of these events ahead of them, and of course may have some part of the reaction on the event itself. But I want to highlight one fundamental point here. If the narrative this year in our economy is going to be of a very good growth recovery, and given that the last 2 years we had few one-off impacts also, if we see a good growth recovery and if we see some increase in rates, I think we will be quite fine. We are not talking about here money becoming quite expensive. We are just saying that from an extremely low rates, we are seeing some normalization. Of course, just pure on a cat's, your discounting rate changing will make your stocks look more expensive. But I think growth is where a lot of the focus will be. And that is what I spelled earlier, that if you see growth recovering back and if you see valuations becoming more reasonable, that pocket of the market is going to attract more attention. And I think if you look at from 1st Jan till now, the market has already been exhibiting that divergence between the very expensive stocks and the stocks which are still reasonable.
Good morning, Rajat. This is Nayantara. So let me try and put it in as crudely as I can. So if you've seen the third quarter earning results, we've seen resilience, right, from the corporates. The PEs and valuations on the stock markets may be a different story altogether. But after the big event of yesterday and in light of the rising bond yields, tell me, what are you folks at Motilal Oswal betting on? Like, are there any stocks that you figured out their fortunes are set to change after yesterday's budget?
I think, okay. So let me also answer as straight as I can. I think what one thing that the budget does yesterday is that it continues the growth momentum in the economy. Point number one. Point number two, I think a lot of the growth has to come from outside the budget, which is from the corporate sector and the private consumption, right? The third thing that we need to watch here is how the rural economy shapes up, because that is at least one piece which in this entire earnings season, we have seen some voices of concern coming in. But I think, please note that we are coming from a low single digit credit growth to almost staring back, getting into double digit in the next 1 to 2 quarters. We have not seen that over the last few years. Secondly, we are seeing almost all the top industrial houses talking about doing a capex cycle that they have not done in the last 5-7 years. And the third, right, the global commodities, which has partly caused the inflationary pressures, is also going to boost the entire capex and the working capital system. So I think growth recovering back, and whichever sectors will see that growth leading the charge would be the one. I agree to you that the PE valuations at all points of time don't matter. But I think at this point of time, the market is very wisely selecting on recovering growth at good valuation versus modest growth at very expensive valuation.
So you're not going to give me straight up stock specific ideas?
Just last night itself, we released our post-budget document, which has a host of ideas both in large and the mid-cap picks. So let me just, I'll definitely spell out the names also because we have published that. But I think the 3 themes which I'm most positive on right now. First, I think financials, and especially the ones which have used the last 5-7 years for a significant cleanup, are going to see a cyclical upturn in their P&L account, coming right from the top line growth to the credit cost. And the markets are going to pay some crazy multiple in the cycles to come for those earnings. We have seen how within the banks itself, you are seeing the likes of ICICI, Axis, SBI outperforming the winners of the last decade, which is either an HDFC Bank or a Kotak Bank. And I think this trend may persist for some time purely because earnings surprises and valuation gap is happening. The second, I think we are very positive on the entire small ticket consumption item, including domestic tourism. I think once we are fortunate and we are both happy that at least this part of this COVID has been very short-lived and we have started seeing things recovering quite back. I think people are going to move out, people are going to spend. Yesterday, you saw the results of Indian hotels, which is one of our top picks, which we have outlined. Again, fantastic numbers and a very good outlook. And I think the third space that we are quite positive on is some of these companies which got impacted temporarily either because of input prices or the supply chain disruptions. Select autos, select cement. So, our note publishes all our topics within both large and mid cap. But I think please understand our common theme is that recovering growth at reasonable valuation will see outperformance this year. This year is not going to be the year like last where you started the year at a low and ended the year at a high. You had a almost a one-way up move. This year you will see volatility, but I think you will see a lot more valuation catch up happening and not just expensive becoming more expensive.
Point taken, and yes, indeed, Indian Hotels, dhamaka set of numbers, and the stock has rallied very smartly from those 180 levels now to about 220. Rajat, it's been a pleasure chatting with you about stocks, sectors, and your overall view on the Union Budget.